Welcome to the deep dive. Today we're really digging into one of the stranger earnings reports, I think, from this season.
Definitely paradoxical.
Yeah, Flexsteel Industries, ticker FLXS. This is following their fiscal Q1 2026 earnings call, which was just yesterday, October 21st.
And it's worth a deep dive because, honestly, this quarter feels like a real pivot point, not just for Flexsteel, but maybe for the whole sector.
Right. So the mission here is to figure out why a quarter that looked, frankly, fantastic on paper, why it was met with such a negative reaction from the market, like same-day reversal.
Exactly. It's this classic case of, great internal execution running smack into this huge external kind of unpredictable headwind.
Okay, so let's start with the good stuff, the facts, because the financial results themselves, they were genuinely a significant beat, weren't they?
Oh, absolutely. A clean beat, top and bottom line. GAAP earnings per share, $1.31.
131, and the consensus was?
Zach's consensus was only $0.78. So, that's a 68% beat, a huge surprise.
Wow. Okay, that's massive outperformance on profit. What about the top line, the revenue?
Revenue came in at $110.4 million. The street was looking for about $104.1 million.
Yeah.
So beat there too. And maybe more importantly, that's 6.2% year-over-year growth.
And management highlighted something there, right?
Yeah, they made a point of saying this is their 8th straight quarter of year-over-year sales growth.
8 straight quarters. In this kind of consumer environment, that's pretty remarkable consistency.
It really is. It suggests, their strategy was working, and they weren't just growing sales. Like you said, they were boosting profitability quite dramatically too.
Right. So talk about the margins.
Okay, so net income was $7.3 million. But the key thing, I think, is the operating margin. It expanded significantly to 8.1%.
8.1, and
that's up 230 basis points from 5.8% in the same quarter last year.
Okay, substantial expansion.
Yeah, and they showed good cost control, too. SG&A, selling, general, and admin costs. They trimmed that down to 15.4% of sales from 15.7%.
So purely looking at the numbers released before the call, that initial optimism, shares indicated up, 12% or so pre-market? That made sense.
Totally justified based on the print itself. Absolutely.
All right, let's unpack that operational strength then. Because management, they clearly had their house in order. It wasn't just cost cutting, right?
Yeah.
What was actually driving that growth and margin expansion?
Well, it seemed pretty broad-based, which is usually a good sign. They mentioned new products doing well, gaining share with strategic accounts, especially in their core area, soft seating.
Okay.
But they also called out ramping sales in case goods and their newer health and wellness categories. So that diversification seems to be kicking in.
And this was happening even though the overall market for furniture sounds pretty tough. Management called it uneven.
Yeah, uneven was the word. They said weekly consumer traffic and sales were especially volatile and shaky. Cited the usual suspects: inflation worries, slowing job market, weak housing.
So if the market's that choppy, how are they positioned to handle shocks? What about the balance sheet?
That's their shield, really, their financial discipline. They ended the quarter with strong working capital, about $117 million, and importantly, a healthy cash pile, $38.6 million, with zero bank debt.
No debt. That gives them flexibility.
Exactly. The kind of flexibility you absolutely need when something unexpected hits. They had all the internal levers working: sales leverage, cost control, productivity gains. It was all humming along.
The market just wasn't looking backward. It looked forward and saw this huge storm cloud gathering right at the end of the quarter.
Yeah, this brings us to the tariffs, the elephant in the room.
The thing that completely wiped out all that operational goodwill. So what exactly happened, this massive structural shift?
So the White House issued a proclamation, new, larger Section 232 tariffs. And these hit a range of imported goods, specifically including timber, lumber, and critically for Flexsteel, upholstered furniture.
Okay, maybe just quickly explain Section 232 tariffs. Why are they different? Why so disruptive?
Well, Section 232 tariffs are imposed based on national security concerns regarding imports. The key thing is they often come suddenly, they can be broad, and they bypass some of the usual trade agreement rules.
And the really big change here was Mexico, right? The USMCA exemption.
Exactly. That was the bombshell. This new action eliminated the USMCA tariff exemption that products made in Mexico used to enjoy.
And that exemption was crucial for Flexsteel's supply chain as it stood.
Oh, absolutely critical. Their sourcing mix before this was like roughly 70% from Asia, mainly Vietnam, which already faced a 20% reciprocal tariff.
Okay.
The other 30% came from Mexico. And thanks to USMCA, that was duty-free, 0% tariff.
And now
Now, Mexico-sourced products lose that exemption. So this means over 90% of the company's total sales, their upholstered furniture business, is going to be hit by this new higher tariff structure.
90%. Wow. So on that 30% from Mexico, they go from zero tax to what are the new rates?
Okay, so effective October 14th, so just recently, the tariff on upholstered furniture from both Vietnam and Mexico jumped to 25%.
25%. Ouch.
And wait, there's more. Here's the real kicker. By the end of this calendar year, that tariff goes up again to 30%.
30%.
Right.
That's brutal. It's like an earthquake for the industry, especially given how much furniture is imported, right?
Yeah, something like 65% to 70% of all U.S. furniture consumption is imported. So this hits almost everyone.
So faced with this, what's Flexsteel's plan? How do they mitigate? Specifically on pricing, are they just passing that whole 30% hit straight through to the consumer?
No. And this is where it gets really interesting. This is where they're trying to leverage that strong balance sheet we talked about, maybe turn this crisis into a competitive opportunity.
Ow.
They put in place a 15% pricing surcharge on the affected products. 15%.
Wait, so just to be crystal clear.
Yeah.
The tariff is going to 30%, but they're only increasing prices by 15%. They're just eating the other 15 points of margin.
That's exactly right. They are explicitly absorbing roughly half of that ultimate 30% cost increase themselves.
That seems incredibly aggressive. Almost weaponizing the balance sheet. Isn't that super risky, especially with housing looking weak?
It's a profound risk, no doubt. But it seems like a calculated one. They're betting, I think, that their competitors, especially those maybe without that cash cushion, without zero debt, will be forced to pass on much more of the cost.
And what are competitors doing?
Management mentioned on the call that they're seeing some major competitors pass through much higher increases. Figures as high as 21% to 25% were mentioned.
Ah, okay. So Flexsteel is deliberately undercutting them on price, even at the cost of short-term margin.
That seems to be the strategy. Play the long game. They hope this pricing discipline leads to gaining significant market share while the industry struggles with demand compression from higher prices overall. Then they emerge stronger when things eventually normalize.
Okay, that makes sense now why they had to pause guidance. I mean, how can you possibly forecast demand when you've got a 30% industry-wide cost shock and you're deliberately choosing to sacrifice margin for potential share gains?
Exactly. Way too much uncertainty. And that lack of a clear outlook, that probably spooked the market just as much as the tariff itself, contributing to that stock sell-off despite the Q1 beat.
So even with this huge regulatory curveball, they're trying to stay on offense. It's not just about defensive pricing. Let's pivot to that strategic story. How else are they trying to win share? Product seems key.
Yeah, product innovation is the other pillar. The best defense against margin pressure, often, is having products people really want and are willing to pay a bit more for, especially premium products.
And they have a target for new product contribution.
Their long-term goal is 30% to 40% of sales from new products.
Yeah.
But right now, they're actually crushing that. In Q1, new products were over 50% of sales.
Over half their sales from new stuff.
Right.
Wow. And the recent High Point Market, that was their big showcase for this, right?
Huge showcase. They called it a record year for new product introductions. 26 new product groups, 226 unique SKUs. They're clearly trying to shift the conversation away from just, basic furniture towards something more experiential, which you kind of have to do if prices are going up everywhere because of tariffs.
Tell me about these new sub-brands then, Pulse and Zen. It sounds like they're really trying to push the envelope on what furniture does.
They really are. So Pulse, that's their move into high-performance home entertainment furniture. It's power motion seating, but it has a built-in immersive sound system, even synchronized vibration. Think turning your sofa into part of the home theater experience.
Okay, interesting. And Zen?
Zen series is all about wellness. It's trying to blend design, aesthetics with actual wellness tech built right in, things like heat, massage, even therapeutic ventilation. The focus is on restoration recovery, bridging that gap.
So essentially, they're hoping consumers will stomach the tariff-driven price hikes because they're getting something much more functional, more tech-infused, more valuable than just a standard sofa or chair.
That's the bet. And they're backing it up with marketing spend, too, focusing on tailoring the message, driving traffic to their retail partners using paid search, social media, and improving the actual in-store experience. Better point-of-sale materials, things like that.
Makes sense. If you can get someone to actually sit in a Pulse or Zen chair and feel the difference.
The conversion rate probably goes way up.
Okay, so wrapping up the analysis part. the whole story really boils down to this tension. Can their proven execution, their strong balance sheet enabling this aggressive pricing and these innovative premium products, can all that overcome the huge wet blanket that these tariffs are throwing on consumer demand across the whole sector?
Right now, the market's vote seems to be no. Skepticism is high that even great execution can beat a 30% tariff headwind.
Which brings us neatly to the market reaction and our favorite segment. This is not financial advice.
Indeed. Let's talk about the stock itself.
So FLXS closed yesterday at $36.49. That's after, as we said, reversing that big pre-market jump. It's been pretty volatile lately, kind of bouncing around between, what, $36 and $45.
Yeah, choppy range. And this is while the broader consumer discretionary sector, the XLY, has actually been quite strong over the past year, up around 20%.
So you've got this difficult mix. Great company execution, terrible external macro risk. What's the outrageous but plausible trade idea percolating here?
Okay, so disclaimer firmly in place,
Yeah.
not financial advice.
Absolutely.
The outrageous but plausible idea stems from the belief that the market has maybe overreacted, that it's fully priced in the worst-case scenario for the 30% tariff, and is completely ignoring the 8 quarters of margin expansion and that fortress balance sheet.
Okay, so what's the trade?
The idea would be go long FLXS, but hedge it. Hedge it by shorting a basket of their key competitors.
A paired trade. Interesting. What's the specific thesis behind pairing long Flexsteel against short competitors?
It hinges entirely on that pricing strategy we discussed. The thesis is Flexsteel eating half the tariff hit, only passing on 15%, will allow them to steal significant market share from competitors who are forced to pass on more like 20%, 25%.
So while the whole industry likely sees demand shrink short-term due to higher prices,
Flexsteel's slice of that shrinking pie gets disproportionately bigger. Their relative price advantage, combined with their cash allowing them to withstand the margin hit better than maybe indebted competitors. It lets them think bolder, as they put it.
and the catalyst for this trade working out would be?
The next earnings report, probably around February 2026. If they come out then and can actually show data proving they gained market share because of this strategy, then the narrative flips and the stock could reverse sharply higher.
That's a gutsy call. It's basically betting entirely on market share gains trumping short-term profitability hits, and that management's gamble pays off.
It is. It's purely a bet on market share accretion, driven by pricing discipline in a disrupted market.
Well, this has been definitely a fascinating deep dive. Flexsteel Industries, a really stellar operational quarter, completely swamped by this sudden massive tariff shock, hitting, over 90% of their business.
And they're fighting back with innovation, with that aggressive pricing strategy.
Yeah.
But the core uncertainty remains huge.
Yeah. The biggest variable for next quarter, it seems, isn't even Flexsteel's own execution, which, as you said, has been pretty flawless. It's how the consumer reacts to these price increases across the entire furniture industry.
That's the multi-billion-dollar question.
So the final provocative thought we'll leave you with is this. Can these fancy new products, the Pulse Entertainment seating, the Zen Wellness chairs, can they actually create enough perceived value to justify these new higher price points? Can they keep that sales momentum going against both the tariff headwind and a shaky housing market?
Time will tell.
Yeah.
And so will consumer wallets.
Thank you for joining us for this deep dive. As always, remember, everything discussed here is purely for informational purposes. We hope you'll join us again next time.